Good afternoon and good evening, everybody, wherever you're joining us from in the world. As Chair and President of the Chartered Banker Institute, it's my very great pleasure and privilege to be introducing today's virtual conference. It's the first of two short days discussing responsible banking and how the banking sector and community are interpreting it, both within their organisations and as individuals in these challenging times. This is the seventh time the Chartered Banker Institute has hosted such a conference, but it's the third successive year when we're holding the conference virtually. That allows us to reach as many of our members around the world as we can, and it also helps others to join us from other institutes around the globe today. You're all most welcome. Let me start my remarks by saying that although this conference will be primarily focusing on responsible banking over the next couple of days, I've looked around and there is in fact no official definition of responsible banking, but the Institute does have its own short definition of what a responsible banker is. A responsible banker is one that is clear on what is the right thing to do in the interest of society, the environment, and for their customers. So I trust everyone watching is happy to consider this topic of responsible banking with this in mind. And no doubt we will touch on many of these characteristics throughout the course of the next 2 days. Anyway, moving on to today's proceedings. In a moment, we'll be discussing what responsible banking looks like in a global inflationary climate. And tomorrow we'll be looking at why responsible banking values matter, with a particular focus on how the UN principles for responsible banking are being implemented by banks who have signed up to them, and how the new Principles of Responsible Banking Academy is supporting that endeavour. So please sit back with a coffee or whatever drink takes your fancy at this time of day and enjoy what I hope will be two very enjoyable, thought-provoking days, looking at most aspects, if not all aspects, concerning responsible banking and the challenges and opportunities they're presenting to banks and bankers. Now, for those viewers who may not already be aware, the Chartered Banker Institute was founded in 1875, so we have nearly 150 years of experience in educating bankers. And with a network of over 33,000 professional bankers around the globe, we're proud to be regarded as the voice of responsible and sustainable professionalism in banking, with a focus on a responsible banking agenda, emphasising the importance of education, skills and training in banking. We were one of the first UK organisations to endorse the UN Principles for Responsible Banking, and we also support the wider attainment of the UN Sustainable Development Goals. Our work in supporting how banking can play its part in meeting the environmental challenges that the world faces has led to the development of a unique global academy with the United Nations Environment Programme Finance Initiative. The PRB Academy, which is covered in the video you just saw, officially went live yesterday, and it will provide professional training for banks and their staff on sustainability and social issues, framed in the context of the UN Principles for Responsible Banking and the UN Sustainable Development Goals. The objective of the PRB Academy is to give all bankers from the back office to boardrooms the tools needed to apply a sustainability lens to their professional activities. Alongside this, the international influence and collaboration we have been building through our partnerships with professional bodies in Africa, Australia, the Bahamas, Hong Kong, India, Ireland, Malaysia, Malta, New Zealand, Pakistan and Taiwan, to name quite a few, has been a continued focus of the Institute. We're now proud to have students and professionally qualified members in 107 countries across 6 continents, all of whom share a common commitment to the Chartered Banker Code of Professional Conduct and to our global family of members. It's great to have so many of you able to join us online today for this conference, and thank you once again for your invaluable contribution to making the Institute such an important community. I'd particularly like to pay tribute to our international partner institutes, the AICB in Malaysia, FINSIA in Australia, and also thank the Global Ethical Finance Initiative, better known as GEFI, and last but not least, UNEP-FI, in particular for supporting this event for the next 2 days. I give a warm welcome to all our members and all those associated with them for joining us today. It's a partnership like this that underlines the strength of our banking community, and long may it continue. We certainly find ourselves in a challenging environment as businesses and individuals. The first pandemic for almost 100 years is still with many countries, and war has broken out in Europe for the first time in 25 years. The impact on commodity prices has had a profound effect on living standards in the developed world and on heightened poverty in many developing nations. Recessions, inflation, and a squeeze on real earnings are a tricky combination for banks. On one level, banks want to support their customers, be they personal or business, so that they come out the other side ready to enjoy the recovery. But at the same time, there is moral hazard in lending more when affordability is tight and getting tighter. And there is a need for a duty of care to shareholders and depositors whose money is at risk. One can also argue that there is a duty of care not to let customers become stretched financially. But that's a very hard call when much of the recent increase in credit card debt, at least in the UK, is not for luxury holidays, but to put food on the table and energy in the meter. The scale of economic challenge seems to be growing by the day. And whilst one can point to global instability for pressures in the supply chain, it is clear that there are winners and losers in this evolution, and that the extremes are probably wider than they have ever been and can only be narrowed by fiscal intervention at both ends of the system. Interest rates have and are rising across the world as economies seek to tackle inflation. Analysts forecast rates of 5% in the US, 3% in the Eurozone, and somewhere between the two for the UK. Whilst low in historic terms, certainly if you're as old as I am, these rate increases are significant for the younger generation, who have only ever known mortgage rates with a 1 in front of them, followed by a dot. Some households may be faced with a 3 to 4-fold increase in monthly outgoings that will be hard to accommodate whatever changes they make to their lifestyles. The tools we have always used to fight inflation by taking capacity out of the market and thus forcing a price correction through demand changes may, after a period of soft monetary policy, which has allowed employment to reach capacity levels, albeit at relatively low wage points, not work as it did in the past, when the medicine was delivered to a very different body. The dose may have to be somewhat higher and with far greater collateral damage to the fabric of society, creating a diversity of outcomes that are probably far greater than at any point since the end of the Second World War. How politicians, institutions, and society navigate these challenges will undoubtedly influence the pace of recovery, as the deeper the divisions, the longer the time it will take for a fairer equilibrium to be restored. So why does this matter? Aside from the fact that we would all prefer to live in a society where we all share in prosperity, history tells us that fractured societies can lead to adversarial and extreme outcomes, distrust, and ultimately challenge to convention and institutions. Facing into the broader environmental and social challenges we encounter against such a background will make progress in achieving the UN sustainable goals even harder than they already are. As bankers, we are not politicians, but we do have a part to play in being responsible, being empathetic, and seeking to build the foundations for a recovery. We need to lend responsibly in terms of risk and return, but to be seen to be making exceptional profits at a time when many are facing difficult choices over food and energy to pay their mortgages will do little for our reputation, and more importantly, the sustainability of our business and role in society. It is far too easy to argue that rising profits are just a function of rising rates, when it's obvious that the spreads on loans and mortgages are increasing far more quickly than those on deposits. And whilst it's likely that more provisions will be required, it will be important to find the right triangulation between being socially responsible, looking after the best interests of customers, and rewarding shareholders who have seen returns below the cost of capital for many years. Some banks are getting that balance right, and others seem less able to do so, which will only add to the voices in favour of additional taxation for the sector. Finding the right balance between lending sensibly and on an affordable basis, while showing compassion and consideration to borrowers in difficulties, helping them with interest rate concessions rather than penalties, and giving them time to pay is not an easy ask. Where do you draw the line between a customer just getting by and one in trouble, particularly when the concession you give to the customer in difficulty may mean 3 meals rather than 2 a day for the customer just getting by? Ironically, when loans are sold by major banks to the so-called vulture funds, these funds seem better able to provide a range of solutions that help the borrowers in those portfolios restore their finances. Challenging times call for innovative and groundbreaking solutions. So maybe it is time for a broader approach to helping customers across the spectrum, not just from the mainstream banks, but also from the regulators, who through a somewhat draconian approach to the treatment of non-performing loans have contributed to the inflexibility that exists today. Which brings me back to what it means to be a responsible banker. Being a responsible banker is about understanding and balancing the needs of all stakeholders. Many commentators agree that banks were able to respond effectively to the restrictions placed on business and society by COVID, albeit without the option of digital banking and online communication, that would have been nigh on impossible. Regulation has undoubtedly created more banks for investors, but the jury is out as to whether there is really more choice for the consumer, be that an individual or business. And the cost of credit for those at the margin remains relatively high, and the number of businesses and individuals in that category will undoubtedly increase as inflation squeezes discretionary incomes. The future is, as ever, uncertain, but full of opportunities as well as challenges. Banks will need to evolve and change. Both regulation and society will expect banks to be more responsible in the way that they allocate capital and play a role in how society responds to the climate and housing challenges that lie ahead, not to mention the cyclical challenges of a potentially prolonged recession. Finding the right balance between providing support and good risk management is a tricky balance for any bank. Banks should lend shareholder capital and deposit monies responsibly and sustainably, but they have perhaps been too one-dimensional in their assessment of through-the-cycle risk or the profile of a business or an individual, relying too heavily on scorecards that drive optimal outcomes rather than some of the judgments that help individuals and businesses through many of the economic cycles of the past. And events over the past few years have taught us a lot about responsibility, whether in adapting to changes in how and where we work, how we serve our customers, the communities we operate in, and the wider needs of the society brought together whilst physically apart. That is why we want this conference to demonstrate the challenges of building sustainable and responsible banking models and what that means for banks, bankers, and society. We believe it is our institute's role to help our members understand how you can apply the principles for responsible banking in your work life, what tools you can use, and at a time when customer expectations and demands are changing, we want to enable our members to develop the skills and knowledge to support their customers. Stewardship is the word our founders would have used almost 150 years ago. Today, we would interpret stewardship as being responsible and sustainable. And that is why we define a responsible banker as someone doing the right thing in the interest of society, the environment, and their customers. But in the light of current economic volatility, with energy and food costs rising dramatically, has the importance and urgency of enhancing sustainable banking and finance lessened? Certainly in the short term, it probably has. As many countries battle with energy crises and having depleted their savings and reserves during the pandemic, many households and firms lack the buffers to cope with substantial increases in the cost of living, cost of production, and the cost of servicing debt amidst a backdrop of rising inflation and rising interest rates, leaving them perhaps less able to pay the premium for a product that has been sustainably produced. But the impact of global warming on individuals, communities, and our world will dwarf those of COVID and the current social economic challenges, which is why tackling the climate emergency has to remain a priority for policymakers and regulators globally. From a financial standpoint, central bankers continue to be increasingly concerned about climate risks. In recent years, especially the risks of a rapid transition, stranded assets, and their impact on financial stability. This should prompt action from financial institutions heavily exposed to high carbon assets and move towards reducing fossil fuel exposures in portfolios. And yet much of that progress has slowed this year. But making a real contribution to the challenges we have placed on our planet has to be more than just protecting a bank's balance sheet. For the transition to net zero to succeed, and to succeed by mid-century and keep the uplifting global warming to 1.5 degrees, we must act fast and make considerable progress as early as the end of this decade. In doing so, we clearly don't need all bankers to become deep sustainability experts, but every banker does need the tools to apply a sustainability lens to their professional practice. And this is where the PRB Academy can help, and that's what we'll hear about tomorrow. So I would argue sustainable finance is more important, and mainstreaming sustainable banking and finance is more urgent than ever. Alongside the very significant commercial and investment opportunities for financial services that it provides, there is an even more compelling moral case. Sustainable banking and finance is an opportunity for our banking profession to demonstrate our positive social purpose. We can and we must play a leading role in helping individuals, communities, countries, and our planet transition to a sustainable, more socially just, low-carbon world. As we look ahead, responsible banking needs to be led by professional bankers, and we need to ensure that the future of banking is one that reflects and celebrates the diversity of our world. We live in a global community, and it's absolutely right that we look outwards and face into the challenges that arise from the current economic uncertainty and geopolitical events, as well as climate change. the roles that bankers can play in meeting these unprecedented challenges to our industry, but also to the world in which we and our families live. And these are areas that I'm sure we will touch on a few occasions throughout the course of the next 2 days. Tomorrow, we're delighted to have Simone Decklin from UNEP-FI join us to provide a keynote speech. And this will be followed by a discussion on why responsible banking values matter. But today's topic is responsible banking in a global inflationary climate. So I'd like to thank you all for listening, and I'll now introduce a short video about a new UK-based campaign called Make My Banking Matter, before we move into the panel session.
Hello everyone, my name is Huw Davies and I've been invited to say a few words on the topic of responsible banking in relation to its role in climate change and nature restoration. I have a background in sustainable finance, having been a member of the senior team at Triodos Bank in the UK for almost 10 years, and I'm currently senior finance advisor to a public campaign called Make My Money Matter. I hope my short piece of content here provides some interesting food for thought and perhaps a different angle. A few words firstly about the campaign. Make My Money Matter was co-founded by Richard Curtis, film director of Love Actually fame, a couple of years ago, and we want to give more voice and choice to people over their money and align finance to a sustainable future. We're primarily a public-facing campaign using creative and educational content to boost awareness and action amongst the public, but we also run a successful strand of work focusing on businesses and their financial footprint, as well as engaging with the finance sector to encourage, challenge and hold to account. So far, we've focused on pensions, aiming to get as much of the £3 trillion in UK pension schemes aligned to credible net zero targets and delivery against them. Such huge amounts of long-term money has the potential to shape a sustainable future, but also the potential to drive destructive climate change and nature loss, and create a world that none of us would really choose to retire into. We produced several influential reports, including one showing that over £300 billion of pension fund investments are in companies and financial institutions with a high risk of driving deforestation. We've also raised awareness amongst the public, industry and government about the importance of how our pensions are invested. I could say a lot more about pensions, but given this event is the annual banking conference, I'll turn to banking. The vast majority of the UK public, of course, has a relationship with a bank, and usually it's one of the big high street names. Make My Money Matter will be launching a public campaign very soon, focusing on the largest UK high street banks, HSBC, Barclays, Santander, NatWest and Lloyds, and their financing of fossil fuel expansion. Because the fact is that our banks are continuing to provide billions in financing to fossil fuel companies. In fact, between 2016 and 2021, HSBC, Barclays, Santander, NatWest and Lloyds provided a collective $141 billion to the largest upstream oil and gas expanders. All this despite the fact that the International Energy Agency announced last year that there can be no investment in new oil and gas fields if we are to achieve net zero by 2050 and limit the rise in global temperatures to 1.5 degrees. To address the issues of expensive energy and energy security, we must focus on ramping up clean, renewable energy and efficiency measures such as insulation, rather than expanding fossil fuels which lock us into carbon addiction for years to come, blow through our carbon budget, and of course create stranded asset risks for the finance sector. That's why we're calling on our major high street banks to stop financing fossil fuel expansion. Firstly, by taking the step to stop the direct financing of any fossil fuel expansion activities, and then to serve notice to their clients that are involved in fossil fuel expansion activity that they will cease to provide any new finance to them unless they stop these activities. And as I record this film, it's brilliant to note that just yesterday, Lloyds Bank in the UK announced that it will not provide direct finance for new oil, gas and coal projects. Although there is much more to be done, this important symbolic first step from a major UK bank means that others should now follow. Because if they don't, then their customers will want to know why. Responsible finance also means how banks are portrayed through advertising. In a climate emergency, there can be no tolerance for greenwashing. So it was good again this week to see the UK Advertising Standards Regulator declare that 2 climate change adverts from HSBC are banned for being misleading about the company's work to tackle climate change. It upheld complaints that the adverts omitted significant information about HSBC's contribution to carbon dioxide and greenhouse gas emissions. There's clearly focus and momentum here. The finance sector, be it banks, pension funds or insurers, has a huge role to play in shaping our collective futures. And these institutions are run by people, of course, individuals such as all of you, people who I have no doubt share common concerns about the futures you and your families will experience as we see more and more evidence around the world of the impacts of climate change and nature destruction. So let me finish with an appeal to you all that as you go back to your jobs, whether you're a CEO or an intern, consider what you can do to create with others a bank that you can really be proud of. If you lead an organisation, show that bold vision that's now needed. If you are new to banking, make your voice heard in your company about the kind of bank you want it to be. This is the collective global challenge of our generation. Banks have a crucial role to play. And you as bankers must deliver urgently because the public, your customers, will expect nothing less. Thank you and really hope that you enjoy the rest of the event.